Every new trader and even experienced traders needs these three indicators. They're a must on our trading floor, and today we're going to reveal them and how you can use them. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and Miami, and proud to develop numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from the team at our prop firm so you can grow your trading account.
I'm going to outline the top 3 indicators that I think every new trader should start with. So this refers to day trading, swing trading, futures, equities, Forex. It doesn't matter, because these are universal indicators that help quantify time, price, and volume in the most robust and effective way possible. If I had to only use 3 indicators for my own trading, these would be it. In fact, these are the 3 indicators I use every day. And I can almost guarantee that the third one I'm going to cover is not what you probably think. So why am I recommending these indicators for new traders? Because they are still the most critical indicators to me. And so these are not just beginner indicators that will get you started. I want to get you on the right path, and you might as well start with the most powerful stuff. So each of these indicators is independent of each other. In other words, they're not redundant, right? There's nothing worse than when a trader is using 3 indicators that all measure the same thing. And as I always say, indicators are not strategies. They are tools that measure specific market dynamics within our strategies. How we use this information is up to us, and how we incorporate them is up to us. And how we outline our own methodologies around our strategies is up to us. So today, I will introduce these indicators. I'll outline why they are so important and cover how I like to use them, so that you can come away from this video understanding why you might want to put these indicators on your chart and study them and learn how to incorporate them into your own playbook. Most of the wide breadth of indicators that I'm familiar with, I use in fully automated or systematic strategies, because automation requires a lot of quantification. But as a discretionary trader, I keep it simple, and I choose to keep it simple with these 3 indicators. So indicator number 1, volume bars. Volume bars measure the number of shares or contracts transacted during each price bar on your chart. So most traders start with volume bars on their charts. They're usually already on the chart when you open your trading platform. But before you go searching for fancy indicators that you think will give you a unique edge, I recommend taking the time to really understand what these volume bars tell you. We can also implement variations on this indicator to better interpret the volume bars, which I'll cover in a second. So why is volume so important? I like to look at volume as fuel. Any market needs transactions to move. This is just how markets work, right? So aggressive orders take liquidity, eat through bids and offers, and move the market to a lower or higher price. Without these orders, the market is going nowhere, right? So if we study volatility, say by measuring the average true range of the stock, we will see that the increase or decrease of the range of a stock is highly correlated with the increase or decrease in volume traded. So take this daily chart of SMCI, for example. If we plot the volume as a blue line, right, and then take the bars away so that we can see this plot easier, and then plot the range of the candles by creating a 1-period ATR shown in yellow, we can see how correlated range and volume are. In other words, volume creates movement. This is why I see volume as fuel. Now, significant volume doesn't mean that we will definitely get a big directional move, right? At specific inflection points, exceptional value can be absorbed by both sides of the market. And this can help us read the market on a short-term basis. By the way, a dynamic that our third indicator today will help us measure. But as a whole, we are much more likely to get big moves if we see significant volume. So just like when driving a car, if we have a full gas tank, right, more fuel, we can now drive 400 miles. We don't have to drive, but we are capable of driving far. If we only have a quarter of a tank of gas, that ain't gonna happen. And we see this on higher time frames. So situations where it's very easy to see the fuel behind a move, very easy to see that this stock, since the breakout is in play, has generated interest and has the potential to move. And if we rewind to day one of this move, the fuel showed itself from the very beginning. Volume is telling us that there's interest in the breakout. There's fuel behind this move. This breakout has potential. It is then our job to continue to read this volume in price action and determine whether the stock is sustaining this volume and whether the fuel is still there. And we see this dynamic on lower intraday time frames as well. So if news breaks in a stock, I may not know immediately if the market cares about this news, but the volume is going to tell me if the market cares. And I'm going to pay attention to not only the magnitude of the volume bars, but also how well the volume is sustaining. Like in this BABA example, where the significant volume is sustained extraordinarily well. This is a huge edge in this trade. When the volume does not sustain, this is a big time information point. So here's Merck on the same day. It shows initial interest on the spike, right? There was breaking news in Merck as well. But then the volume just dies right back down to the levels it was trading at before the news, and the stock can't hold. The car isn't driving all the way to Philadelphia without fuel, right? So volume lets us measure the participation and positioning of the market at key moments. So what do I mean by that? Well, here are two classic examples. If we see significant volume at the start of a move, it can signal increased interest in market participants and a likely continuation of the move, especially if this significant volume sustains, right? So in this case, we've got fuel behind a potential move, right? Looks like we've got gas in the tank to drive to Philly from here. We can also see volume capitulate to the upside at the end of a large move as price speeds up. It can signal that participants are capitulating and that price is likely to exhaust and mean revert. So in this case, the fuel behind the move just blew out and we need to bring the car back to the station. Now, we can determine significant volume bars by examining their relative size or the actual contracts traded. Right? This is enough to be highly effective. But we can go one step further if we want to help quantify significant volume and help us see these moments more easily. For example, we can plot the average volume bar and see if our volume bars are above or below this average and by how much. We can also go even further and quantify how many standard deviations each volume bar is above or below this average. And this is my favorite way to do it, right? So I've done this here with the color coding of the bars, right? Any bar that is cyan blue for an up bar, or magenta, right, for a down bar, or yellow for a directionless candle, these are all at least 2 standard deviations above average, right? All the colored bars. And any white bar is above average, right? But not above 2 standard deviations. And any dark gray bar, and you can barely see them, and that is intentional, is below average, right? Meaningless volume bars. This is a way to define outliers, a way to determine significance. If it's a bright color, this is significant volume. I've outlined how this is built, right? The math is what they call a z-score in statistics. You get the average volume over a look-back period. You get the standard deviation over the same look-back period, and you subtract the average from your volume bar and divide it by the standard deviation. This will tell you how many standard deviations your volume bar is above or below the average. Right? If you don't attend my meetings on Tuesdays where I share this indicator, a TOS indicator that comes with the platform does a similar thing. It's called relative volume STD. It plots the z-score for each volume bar. Right? It plots the number of standard deviations above or below the average for each volume bar, measuring the bars on a relative basis rather than pure shares traded. And if you use volume in this way, you should be aware of the typical volume cycle of the day. As you will see with every stock, almost every day, we get a surge of volume near the open, a drop in the afternoon, and a surge back into the close. This is very typical. Volume is not linear throughout the day. And this is because institutions will participate during times with the most liquidity. This happens around the opening auction, during the price discovery early in the session, and into the close auction in the last 10 minutes of the day, right? Not during lunchtime when most traders are at lunch. So we can expect a few 2 standard deviation bars at the open and a few 2 standard deviation bars at the close. This is very typical. But when a stock exhibits behavior outside of this typical volume cycle, you should take note. The more you watch volume in this context, the more you will get used to what is typical and what is abnormal intraday. Indicator number 2, VWAP. So VWAP stands for volume weighted average price. It measures exactly what it says it measures, the volume weighted average price from a specific point in time. So what does this mean? Well, if we measure the average price from a specific point in time and weigh that average by the volume done at each increment, we get the average transaction price in the stock since the beginning of the calculation. So the VWAP shows us a price level representing the average share or market participants since the beginning of the calculation. This line in the sand tells us who is in control of the market, the buyers or the sellers. I first learned about VWAP when I came to SMB. Every trader was using it. Mainly the classic intraday VWAP method of anchoring the VWAP from the beginning of the trading day at 9:30. And most platforms have intraday VWAP, right? This is a crucial tool for day trading. And I'll tell you a little story about one of the traders on our desk, one of the most successful active traders in the space, actually. I mean, if there's a Hall of Fame, he's in it, right? So all traders have their own kryptonite. His is shorting on the front side. And this means getting in front of a trend, shorting before the stock has turned. And at the firm, we come up with solutions for these things. So Bella made the observation about losing too much money shorting above intraday VWAP. This trader instituted a rule defining how much he will lose shorting above VWAP. His risk is designed totally differently above VWAP when he's shorting stocks. And when he does lose too much above VWAP, of course, Carlton will tap him on the shoulder and remind him, right? And so this worked. And now this has become a general rule that was spread to others on the desk and expanded to the long side as well, and is now an internal rule for the firm that we teach. So for example, here's a daily chart exhaustion setup, right? One of these types of setups where we might apply this. Let's take a look at these 3 days leading up to the blow-off as MSTR really started to heat up. So the pink line is intraday VWAP for each day, right? Each anchored from the open of the day. Notice how little time the stock spent below intraday VWAP on day 1, also on day 2. And day 3, it tested it much more often, but still spent most of its time above VWAP. Buyers remained in control. Shorting this stock was very difficult on these days. But on day 4, as soon as it broke off the open, the stock spent all day below VWAP. Shorting the stock was much easier on this day. And of course, this is the day that it went backside, right? So if we can use VWAP to understand whether buyers or sellers are in control, we can design the methodology for our trades accordingly. So this VWAP level can be used as a key inflection point for a stock, especially if it is in play and trading at a significant level of volume. So there are times when a stock is particularly strong and will hold VWAP on every pullback. This is the definition of buyers in control, right? Sometimes a stock's particularly weak and will get sold at VWAP on every rally, and this is the definition of sellers in control. And sometimes a stock is chopping around, right? Trading in a range above and below VWAP. In this situation, neither sellers nor buyers are in control. Either the market is resting, right? There's no significant participation in the stock on that day, or there's a battle between the buyers and the sellers, right? So an equally important environment to be aware of. All right, I'll get chopped up in this environment if I'm not aware of it. We can anchor VWAP from any point in time on any time frame, right? So not just intraday from 9:30, we can change the anchor point. And a lot of platforms have this as well. I like to do this when there's a significant inflection in the stock, either news or technical, because I want to be able to answer the question, are buyers or sellers in control since this inflection? For example, I'll anchor VWAPs from earnings announcements, right, as we see on PLTR on the daily chart and Oracle on this 30-minute chart. Or I might anchor it from the election, as we see on this Bitcoin chart, right? So if you want to study this topic in more detail, I highly recommend Brian Shannon's book, Maximum Trading Gains with Anchored VWAP. Brian's a friend of the firm. He's done more work with anchored VWAP than anyone I know. Brian is so good at what he does and so simple in his approach that I often reference his work in these videos. Indicator number 3, the tape. All right, so for those of you who expected my third indicator to be something like MACD, I'm sorry to disappoint, but yes, the tape is an indicator and a tremendously powerful tool in trading. The tape lets you see the orders being executed on the bids and offers in the stock you're trading. The market dynamic that the tape quantifies is order flow. So order flow refers to the constant stream of buy and sell orders in the market, right? The interaction between buyers and sellers. This is the stuff that influences price movements. Tape reading is a way to see the order flow of the stock you're trading. Now, we don't have enough time for me to teach you how to read the tape comprehensively. Tape reading requires practice, but I will show you what the tape is, how to understand the concept of tape reading, why it's so important, and how to practice. So the tape consists of 2 components, the level 2 and time and sales. The level 2 is the order book. It shows the bids and offers for the stock you're watching. These are the passive orders that are just sitting in the market waiting to be taken. The highest bid and the lowest offer comprise what we call the inside market. So when you place a market order or any type of aggressive buy or sell order, you can see the bid or the offer you will be taking and its size on the level 2. In fact, you can see all the orders throughout the order book on the level 2. This is called the depth of book, and this is liquidity. Now, the time in sales, also known as the print, is a record of real-time transactions that are going off in the stock you're watching. These transactions represent aggressive orders that are hitting the order book and taking shares from the bid or the offer. Traders watch how the time and sales interact with the level 2. Right? This is how we see the order flow. So in real time, many trades may be going off at once. Traders use the tape as a way to visualize order flow and see the buying and selling pressure at different price points. It can seem overwhelming at first, but the more you watch it, the more it makes sense. And this is why I recommend watching it if you're a new trader. When you watch the tape, imagine the prints on the time and sales as water pressure and the bids and offers on the level 2 as a river dam. The aggressive orders we see print on the time and sales will take shares from the bid or the offer that we see on the level 2 with enough pressure. And if the dam is not strong enough, the aggressive orders will take all the size on the bid or offer and push through the dam to the next price level. This is how markets move. And so the tape can indicate the path of least resistance in a very short-term respect. Tape reading has been going on for over 100 years. It used to be in the form of what they called ticker tape, which came out of a machine, actually, in the olden days. Traders would grab the paper and look at the orders. And now we have modern technology, of course, to see this on a computer in real time. So all trading platforms should provide this indicator. If you want a fun read that helped me understand the tape and its value, check out Richard Wyckoff's Studies in Tape Reading. This book was written by one of the greats in 1910, like over 100 years ago. The same principles apply today. We just have better technology to visualize what he's actually describing in the book. And Wyckoff said in the book, the figures on the tape represent the consensus of opinion, the effect of supply and demand, all combined into concrete units. This is why tape indications are more reliable than what anyone hears, knows, or thinks. So that's Wyckoff's opinion, and I would tend to agree with him. And Jeff is a great resource if you want to learn more about tape reading in this market. Jeff's fantastic at reading the tape, teaching the tape. He's always pulling great examples from each week. Now, when it comes to watching the tape, there are certain things about it that matter. We can note the speed of the tape, how fast aggressive orders are printing. We can note the size of the orders and the size of the bids and offers. We can also note the effect aggressive orders have on bids and offers. I break down my use of the tape into two categories: events and environments. A tape event is a very specific moment on the tape at a specific price level. It allows you to make a trade at that level. It may be a support level that has been tested multiple times. There's a huge, large bid at that price. And you see on the time and sales that the market starts to hit this bid ferociously. The speed of the tape picks up. These orders are all sell orders. This huge bid starts to decrement, meaning that on the level 2, the size of the bid is getting smaller and smaller as they aggressively hit it. The dam may be about to break. Right? You can hit this bid yourself when you see it about to break or as soon as it drops, right? And that's a way to make a trade off of a tape event, right? Or imagine a stock that's been selling off in a straight line. Price is cascading lower and starts to speed up. You may be looking for a reversal. You see volume start to capitulate higher, and as volume increases, the final bid absorbs all of that volume. And you see this on the tape because the bid gets hit with a fantastic amount of selling volume on the time and sales, but does not drop. Then you see on the time and sales a significant amount of buying come in and eat through the offers rapidly. Price moves higher, and you see what we would call a change on the tape at this particular low, which can often mark a significant turning point. So moments on the tape can allow us to time our entries with extra precision. So on the other hand, a tape environment is how a stock trades on the tape throughout an entire day or period of time. We often see this on trend days in a stock. We might have a particularly strong stock, but we can see that it is not only particularly strong on the chart with higher highs, higher lows, holding above VWAP, but we can see that it is strong on the tape, right? Bids that drop tend to refresh immediately. Bids consistently absorb the selling pressure. There's a lot of buying on the time and sales, and this buying consistently gets the job done, taking out offers. And as a whole, there's just a lot of order flow supporting the stock. In this case, the overall character on the tape tells me a lot about the stock on that day, which will play into my decision making in a big way. So my recommendation for any new trader is to watch the tape. You don't have to see everything right away. The more you watch and study it, the more you will start seeing it. And you'll pick up on those little things that connect to your trading style. You can record your screens and return to those moments where you saw a moment on the tape. You can start cataloging all the plays in which you saw a stock exhibit an exceptional tape environment throughout the day. So tape reading is a skill. It's just like anything else. Reading a book is not enough. You have to get in there and experience it to learn it. So let me know in the comments if I missed anything. I'm sure you will. If you're an experienced trader, let me know what indicators you would start with. And if you're new, let me know what indicators you are starting with, and I'll respond in the comments.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. the traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of SMB Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part, you don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.